Hi everyone, my name is Fischer, also known as the New York City Broker. Today I'm going to share some tips with you discussing a buyer's guide to mortgage pre-approval. Mortgage pre-approval is when you apply for a mortgage and based on your credit score and financial standing, the lender will approve your mortgage application and issue you a letter stating that they will lend you a certain amount of money if you meet their condition. The pre-approval letter is usually valid for about 90 days, sometimes 60 days, and it shows the seller that you are a serious buyer that can afford the apartment that they are selling. Mortgage pre-approval usually requires a hard credit check, which becomes part of your credit history and may affect your credit score. So is mortgage pre-approval legally binding? A mortgage pre-approval is not legally binding for you, the borrower, but it might be for the lender. The pre-approval is the lender's conditional commitment to give you a mortgage loan. This means that if you meet all the conditions stated in the pre-approval letter and there is no significant change to your financial standing, the lender may be obligated to give you the interest rate and the loan amount they've stated in the letter. But the approval letter doesn't legally bind you to the lender. Once you have decided on a property, you can shop around for better mortgage rates and terms. The only difference would be that with a new lender, you will have to resubmit all your financial documents. So what's the difference between mortgage pre-approval and mortgage pre-qualification? Mortgage pre-qualification is usually just a calculation of how much loan you can qualify for based on the financial information you provide to them. It doesn't require you to submit your financial documents, and the soft credit check it requires doesn't affect your credit score. It simply gives you an idea of how much mortgage you can afford. Pre-approval is more thorough and requires you to submit your financial documents and requires a proper credit check. Pre-approval is also a benefit for the sellers, so they see that you're a serious bidder, while pre-qualification is really just for you. There are some banks, however, who use these words interchangeably. Make sure you confirm with the bank to see what the exact difference is. How can you get pre-approved for a mortgage? You have to fulfill the mortgage requirements, submit the necessary documentation, and follow the directions of a lender to get pre-approved for a mortgage. You can get pre-approval letters from multiple lenders or get a new pre-approval letter when the first expires after 60 or 90 days, but that's not recommended. Each new pre-approval letter means a new hard credit check that can negatively affect your credit score. If you don't have a great score, it may be difficult to qualify for a mortgage or you will get higher mortgage rates. Therefore, you may consider working with a mortgage broker even for pre-qualification. They will help you shop around for the best rates based on your finances and credit history and connect you with the lender best suited for your mortgage needs. While mortgage brokers can help you get a pre-approval letter, they may not be able to issue one themselves because they are not lenders or financial institutions. You can also work with a broker after you secured a pre-approval letter or when you are shopping around for better rates after deciding on a property. The most common documents needed for a pre-approval are the following. Proof of income. The lender needs to ensure that you have enough income to cover your mortgage payments, so they require proof of income documents. This usually includes W-2 forms going back 2 years, tax returns, and bank statements of the past 2 years as well. The requirements are more difficult for freelancers since banks are worried about their income stability. Employment verification. Some lenders may also require employment verification. This includes an employment verification letter and sometimes pay stubs for the previous 2 years. The lender may also contact your employer for additional verification, proof of assets. When it comes to assets, the lender will be most interested in the financial assets needed to cover your down payment and closing costs. For that, they will look into your cash reserves. If you receive the down payment money from friends or family, you may need to provide a gift letter. This tells the lender that the amount you have received is not a loan that you will have to pay on top of your mortgage which would affect your debt-to-income ratio. Identity documents or other documents. The lender will also require your driver's license and your social security number. They may also ask for your signature to pull your credit history. While it's not a document, your pre-approval letter will also look into your credit history and score. The higher your credit score is, the better. Ideally 700 or more, but you might get decent rates with 680 as well. And while you might be able to buy an apartment in New York City, despite having bad credit, it won't be easy. It's important to understand that there is no real difference between mortgage pre-approval requirements and mortgage approval requirements. The lender will assess your finances the same way when they are approving an actual mortgage once you have decided on a property as they would for a pre-approval. You will need enough financial assets, a decent and stable income, a healthy debt-to-income ratio, and a good credit score to qualify for good mortgage rates. Thanks so much for joining me in this discussion regarding a buyer's guide to mortgage pre-approval. If you have additional questions, please feel free to reach me at brett@thenewyorkcitybroker.com. Also, don't forget to like, share, and subscribe so that you, your friends, and family members can get all the best real estate content. I'm Brett Fischer, the New York City Broker. Have a great day.